So Tom, VanDyk Mortgage has been in business for right around 33 years, but obviously you've been in the business much longer than that.
Well, I don't know about much longer. I'm fighting Mother Nature pretty well, don't you think?
I think you are.
Okay, thank you very
The best
much.
chair in the mortgage business.
Yeah.
So you've probably heard me say before that everything rises and falls on leadership. And I got a really unique opportunity today to sit down and have a conversation with Tom about where he sees the direction of our business going. And more importantly, where are we and how are we positioned as a company to help you guys get there? And we've put just a little video together for you here to kind of share some of Tom's thoughts off the cuff. If there's anything that you need, please know that we're always here to help you out.
But it's interesting because when we opened in 1987, July 10th, 1987, we actually started in August. And then we went August, September, October was the 1987 Black Monday crash. The market was 1,000, 1,200 points, and it dropped 500 points. But interest rates were 14, 15%. I mean, who in their right mind would want to be a loan originator on the street, starting their own company at 14, 15%? But, the system worked. The Fed pumped money into it, dropped rates, and went down about 7, 8%. So it was really a heyday, the post-Black Monday for the mortgage business. And then the 08 crash came, the 07, 08, 09. That one was really the housing industry driven. It was a bubble where the whole industry was making loans to people who simply couldn't afford them. And that whole house of cards crashed. That one I was a little nervous on. That one, because we had, at the time, we were, everybody had to do subprime. You couldn't recruit a loan originator if you didn't do subprime. And anybody watching this video, if you haven't watched the Big Short movie, it's a good one to take a look at. We got caught like everybody else. The pricing from in a 30-day period went from 110 basis points to par. And so we lost 10 points virtually within a 10-day period. And we had about $2 million on our warehouse line. Well, you do that arithmetic, okay, 10 points on 20 million. It's two little over $2 million in one month.
Wow.
Okay. Of course, then you have your warehouse banks just like piranha on top of you because everybody in the industry has the same problem. And then if you remember, they had what they call that O-meter, the implodometer, and every day somebody was on that. So, but we made it through that. This crash I'm not nearly as nervous about because it's really not, I don't believe it's economic driven, it's virus driven. But it does have a lot of people that are a little whacked about it, and rightfully so. But we're busy. I talked to Justin this morning. We'll be pushing over 700 loans. Should be around 160 million. And if you annualize that, that's over $2 billion.
Yeah.
Last year we did $1 billion too. So I don't think we're going to be that high, but I'm pretty comfortable that would be around $1.5 billion, $1.6 billion. So in relation to that, we recently got $40 million more in warehouse lines. We were at $140 million. 60 million. We went to 200 million in warehouse lines, which was a 43% increase. Oh, yeah, like in 08, 07, 08, I mean, I kidded about that. We had one warehouse line with Nat City at the time for $20 million. And you had to beg, borrow, and steal to get that. I mean, because people were lined up. First off, the warehouse banks didn't know if any mortgage company was going to make it through that. So it was extremely difficult to get warehouse lines. So this time around, we pick up, $50 million more in warehouse lines over the telephone. And so Justin did a good job, and so now we got $200 million in warehouse lines. We can turn that about twice a month, okay? And we're approved with Fannie, Freddie, and Ginnie, so even if the aggregators like Wells and Citi and Chase slow down, PennyMac, in their purchasing of loans, we still have the outlet to Fannie and Freddie, which typically turn within 3 to 5 days. Difference being we're going to have to hang on to the servicing. And we're servicing around $300 million. I didn't check this morning, but the last time I checked with John Barnes, I thought we'd see a deterioration of our servicing portfolio. And 4 or 5 days ago, he told me we only had 2 prepayments, which I was shocked at. But obviously, the value of that portfolio has probably dropped 20 to 30% if we were going to go sell it. But we don't intend to do that. I want to grow it. We'll probably grow that to around $1 billion, and we'll think about should we sell it or not. Well, that's the big reason I said that I'm not that nervous about this. I'm concerned like everybody else, but our balance sheets are real strong. We're liquid. We have adequate loan loss reserves. We watch that. We balance it literally on a daily or weekly basis. And I feel real good about where we're at financially in our balance sheets. I usually talk to John Barnes, maybe once or twice a week, and I check in on a daily basis how much we take in. 2 weeks ago, Monday, we took in our historic one-day lock, which was 187 locks for just a slight under $50 million in one day. That bulge is a little concerning because we have to get the LEs out, and we have to that whole bulge is just going to go through the staff. So it's more of a capacity management sometime. But John's going to come out with a video this afternoon as well and give more detail on the secondary markets. But it's really why it's so important right now to make sure you got your loan locked, your customer knows what they're going to get, and then close that thing as fast as you can. We're seeing market movements like yesterday, 200 basis points, 64.30 seconds, which simply means we went from 4.25 in rate to 5 in one day. I mean, so if you took a nap in the morning, you're thinking I'm going to get 4.25, I'm all happy. By the time you go to lock the thing in, it's at 5%. I mean, it's just crazy. We just haven't seen this type of movement. And so that's one of the reasons, a major reason we said, listen, you got to have a loan locked beforehand, because we're going to spend a couple $1,000 processing it, and so are you. You get to right before closing, and the market moves off, and you got 6 loans that you can't close. You got to start all over again. And I do think when we talk about that scenario and rates, I think rates are artificially high right now. I think the aggregators and the Wall Street people, you can't redo $7 trillion worth of business as an industry in 3 months. And that's what's happened when the rates go so low. If we're in the low 3s or high 2s, everybody in the country wants to refi. Mm-hmm. So you got $7 trillion coming in, and we have a capacity with purchases of about $1.5 trillion. Mm-hmm. So there's just no way. So what they do is they artificially increase the rates, and it's kind of in the mortgage industry doing the opposite effect of what the administration wants to have happen and throwing liquidity into the market. The liquidity's there, the economics are there to lower the rates, I believe, okay? Fannie Mae came out with a 2 coupon, which meant we could start writing, 2 3/4, 2 7/8, and then they withdrew it because there was no activity. Mm-hmm. Nobody wanted to, if you can't get the loan locked and you can't get it closed, that's probably the worst, because now you're just hedging product that is not gonna close, and you end up with a lot of pair-off fees. And it's expensive if you don't close the loans, and if you not only close them, but close them in a timely manner. We're not padding the loans. We're looking to see, and that's why I think some people are saying to themselves, look, these rates should be lower, but it's really a capacity issue that we're bumping into. Everybody's coffer right now is full. We're up over last year 78% in volume year to date. I checked with Justice, we're up 78% in volume. That's crazy. I tell you guys, hey, if we can get past this first quarter in our business, we'll have a good year. I think we're going to get past it in the first quarter. The second quarter is going to be very interesting to see how the real estate business reacts, and I'll talk a little bit about that a little later. But the key there is, stay as close as you can to your real estate people. The MBA has put out, their prediction for 2021 that the refis are going to drop 50%. Okay, but they do show a 2 to 3% increase in purchases. So I think the purchase market, once we get over the virus scenario, is going to stay stable. The housing industry isn't going anywhere. It's just too big of a piece of the economy, so I feel comfortable there. And I think we're postured pretty well. Not that we don't have to actively and be aggressive on all these major changes that none of us have seen before. Oh, well, going naked, I know when the rates change, it's almost like you're having a conversation with your borrower today, and you're saying, hey, you want to lock in at 4.5 or 4.25. You got just a minute, hold, I'm going to call and lock it right now. I think that's the market that we're in, and then run, and everybody's happy, run with it and close it as quickly as possible. Nobody has the ability to, what I call go naked, lock with your customer, or they think they're locked and not lock it with the company. All that's going to cause is a lot of losses when you guess wrong, and it's just a guess. And if you can't fix it, they're going to get on the internet and bash you, bash the company. We just don't need that kind of press. I think we'll see the refi boom. I think you mentioned when you say we'll get another bite at the apple. I think it'll kind of go in waves. Rather than just have one boom, I believe what we're going to see is the rates go up a little bit, slow it down, and then once it slows down, the rates are going to drop, and the refis are going to pick back up. So I think everybody needs to stay in contact with their people, and when they're ready to make the jump and refi. When we say there's more equity in people's houses today, I've been looking around the St. Pete area, the downtown St. Pete area for a condo or a house. And you can see what the people purchased it for, and so I've looked at several of them. And what I see, just from being an average buyer, that if you bought a house in downtown St. Pete, at least in the old northeast section, 4 years ago, 5 years ago, it's almost doubled. And so if you bought a $400,000 house 5 years ago, you're asking $800,000 for it today. And that's pretty much across. Now, I don't think that's across the country, sure, but I think there's pockets. And my point is, talk to the people, and a lot of them, I think, would rather, with these low rates, have liquidity if something does happen to their job. Their balance sheet doesn't change. They still have the same balance sheet. The difference is it's not locked up as equity in your home. If you lose your job and you need the money, you can't get a mortgage. So the time to take those loans out is when the sun's shining, and we're going to see, I think, a lot of people in that, particularly in the service industry, in that situation, unfortunately. Well, did you see yesterday Fannie and Freddie came out and put a 60-day moratorium on foreclosure process? That's going to help some people. And we might. I think you're going to see a lot of the service industry people get in the mortgage business, or they're going to get into food business. Like Kroger is hiring 2,000 people, and I heard Amazon's hiring 100,000 people. So you're going to see some shifting from the bar and restaurant business into these other industries, and I think the mortgage business is going to be one of them, and the housing industry is going to be one of them that's going to come out more healthy than the rest. And I think a lot of these are going to bounce back. Some of these travel and the airline stocks have just been devastated. By 50%, 60%. It's crazy. I think the virus scenario is going to go a while, more like the flu. And I think after the next couple of months, I don't know how long we can keep the population on lockdown. I think there's going to be a couple months of that, and then everybody's going to start coming out and doing it. And if they don't have it controlled by then, it's just going to, I think, keep growing. But it's kind of like the flu. I mean, if you Google the flu versus, corona, the flu in the last 3 months, 4 months have had 12,000 people die. And we're living with that. But I do think this is a wake-up call to get our hygiene better, our office environments better. And I think some of it we're just going to have to start living with. and just be much more aware. It'll start, we're not going to be doing as much handshaking. We're going to give the old elbow thing, and we may not travel as much as we used to. But we're going to get over it, and I do think the markets will correct. I'm not nearly as nervous. I was more nervous back in 07 and 08 than I am now. So. Well, I think on your refinances, you're going to continue to have appraisal problems. With the acceleration of equities and particularly on cash outs, expect that because the sales, we got to have cash sales really to make comps, and the appraisers are going to have a hard time finding comps. And back to the lock-in thing, you got to anticipate. I think if you need an appraisal today. And by the way, we all want to run an LP and DU and see if you can get an appraisal waiver on your deals. But if you need to get an appraisal, look at what the appraisers are. They're 3 to 4 weeks out. So we should be looking at 60-day locks if you need an appraisal. And we're starting to bump into hard time to get VOEs and VODs because no one's around. The first thing the big company, they're not going to issue you a VOE if nobody's in the office. So we'll see how that all works. I sometimes feel as I got to turn the TV off because I can't take much more. And watching the stock market, I'm going, wow! If you had extra cash, when do you jump in? And I think there's going to be a lot of people that do that. And we've been through. I believe we've been through worse in the economy, and I still believe this year will end up to be a good year. Maybe not as super as best we thought, but I think it's going to be an excellent year, and I think this whole industry is going to do just fine. I mean, I think we have a good group in our secondary, in our accounting. I think we've got resilient originators. I think that the people that we currently have are some of the best in the business, and I think we just keep our nose to the grindstone. And the good news is everybody's in the same boat. It's not just us that's unique. It's not just us that all these volatile markets and pricing movements happening to. It's happening to everybody. And you're going to see some people who are a little on the weaker side doing some screaming and yelling. And when we're referring to companies who are undercapitalized and maybe taking risks they shouldn't be taking. Anybody out there quoting 2.9% today, I think they're going beyond the line and just trying to get production in, and they're guessing as to what the market's going to do. In this market, I don't think that's a wise thing to do. In any market, it's not a wise thing to do. So keep with your purchase. The icing on the cake here, guys, is this refi business is great. Make the money. I think we're going to have people that are going to make 2-3 times what they made last year. It's not that we're better salesmen. It's just that we're working at it. We're just working hard and keeping our nose to the grindstone. You bet. So feeling pretty good about it.